Good morning. I'm Simone Del Rosario, the business correspondent at Straight Arrow News. It is Friday, October 4th, and we are minutes away from the reason we all got up this morning, right? September jobs report coming out in just minutes, and it'll be the first jobs report that we've seen since the Federal Reserve decided to start its rate cutting cycle. Will that have impacted the jobs? My guest is going to tell you exactly what all of this means moving forward. But here's the expectations for this month's jobs report as we get to it. Economists, the median estimate, are expecting about 150,000 jobs added and a 4.2% unemployment rate, which would be pretty in line with what we saw last month. I want to bring in my guest now. Seth Harris is at the Burns Center for Social Change over at Northeastern University and is the former acting and deputy labor secretary. So, Seth, you know a thing or two about jobs as we get ready for this morning. How are you feeling this morning about what's to come?
I would say that I have very low expectations for this report. We have been averaging about 196,000 jobs over the course of the last year every month.
Hmm.
But over the last 3 months, the number's been much lower, much closer to 100,000. Last month was 142,000. I don't think anything has changed meaningfully, at least prior to the week during which they took the survey that's the basis for this report. I don't think anything had changed that was going to dramatically increase that number or dramatically cut that number. So I think the economist expectations at about 150 is probably right. It may be a little bit on the optimistic side. I would think it's going to be maybe 10 or 20,000 lower than that, but we'll have to see. But I don't think there's going to be anything blockbuster in this report.
How would you describe what the labor market's been doing the past couple of months, especially considering where we were several months prior?
Yeah, it's been getting a lot softer. We have
Hmm.
seen not just job creation decline, but we have seen the number of workers quitting their jobs decline fairly substantially over the course of the last year. That to me is a very, very good indicator, sort of a populist indicator of what's happening in the labor market. If workers feel that they can't find a new job if they quit their current job, they won't quit. And so as
Hmm.
quits go down, that is millions of workers saying, you know what, even though I don't love my job, I probably should stay put right now. The big surprise last month was wages. We saw the largest wage increase number since last July, July of 2023. It'll be interesting to see whether or not this month smooths that out a little bit. Obviously, wage increases are usually an indication of a very tight labor market and workers doing very, very well. But
Hmm.
again, given the job growth, my expectation is that that number will come down this month.
Okay, so you're going to be looking at wages. What else are you going to be trying to pick out of this report? What's going to catch your eye?
The one of the most important things is how, if at all, the job creation is spread out over industries. Last month it was very tightly concentrated in construction and healthcare, to some extent in social assistance. We saw manufacturing go down a little bit last month, but a strong economy where there is solid job growth, you see growth in all or most sectors. So I'll be looking for that. Obviously, the wage number is extremely important, and then you want to see if there's any movement in labor force participation. Are more
Hmm.
people coming into the labor market or are more people leaving the labor market? And part of that is I like to look at the folks right on the margin. So there's two
Hmm.
categories there. There's the group that's not in the labor force but want to work. And then there's the group that's working part time when they really would like to be working full time. If those numbers go up substantially, that's bad news. If those numbers go down, that means the labor market is getting tighter.
Yeah, so we're going to be looking at underemployment, people coming into the labor force, and we've got a lot of changes going on this summer. We've seen the employment situation change because of migration. I want to let our viewers know it's 8:30 this morning, so we are going to be refreshing our computers, looking down, seeing what the data shows.
Wow.
Wow.
It's a wow number.
It is a wow number. Okay. Bureau of Labor Statistics report just came out. Here's the reason that Seth and I are both saying wow. The Bureau of Labor Statistics is reporting that the U.S. economy added 254,000 jobs in September. Remember, the expectation was 150,000. This is mind-blowing as far as what we've been seeing in trends the last few months, especially, and above the 12-month average, I believe, Seth. And unemployment rate is down to 4.1%, so just a tick down. That is a massive number. I just want to let that sit in a little bit. Seth, what are you thinking here?
I am, so as you can tell from what I said just a few minutes ago, I'm very surprised at this number. As I said, the average over the last 3 months has been substantially lower, closer to 100,000, and there's really been nothing dramatic to have changed the trajectory. So the numbers are bouncing around a little bit. It'll be interesting to see if we get any. I haven't looked at this yet, but what the revisions are for the prior months. Yes, what they did is they revised July up by 55,000 and they revised August up by 17,000. So there's 72,000 new jobs over the course of the prior months, not September, but in July and August. So job growth is stronger than we thought it was. Those revisions are sort of the difference between strong and moderate job growth. So it's very, very, very good news for workers. And I'm quickly checking the wage number. The wage number is also very strong at 13
Very
cents
strong.
per hour. That's last month it was 14 cents. So 2 months of very strong job growth. So it was very, very interesting. Last month when the numbers came out and there were BLS made what is for them substantial revisions to the prior month's jobs report, we were all sort of wringing our hands and we thought the labor market was a lot weaker than we had expected and that we had understood. And of course, after this survey was taken, the Federal Reserve cut interest rates by 50 basis points, which is intended to strengthen the labor market. And then it turns out that from this report, the labor market actually was a little bit stronger than we thought it was. Now, that's not to say the Federal Reserve got it wrong. I don't think they got it wrong. I have been calling for rate cuts for about 6 months now. I think that they were late in coming to rate cuts. But what this tells us is the labor market very resilient. It is still quite strong. It is doing well. Not blockbuster, doesn't blow our socks off, but it's a very, very, very good number for workers.
Well, I mean, my socks are a little bit lower than they were at the Seth, we're talking about 100,000 more jobs than we expected to be added.
That's a very underappreciated economic indicator, Simone, is sock level, I think. So we have to pay closer attention to that. I'm sorry. Go ahead. I interrupted you. I apologize.
No. We're gonna enter it in, send it off to Investopedia. They'll be alerted by the end of the day. Okay, so we know that the Fed's rate cut has very little to do right now with what's been happening with the labor market. What do you anticipate the Fed is going to do with this type of data?
Well, this would certainly, well, let me just say the jobs numbers are only a part of what the Fed takes into account and has previously not been the priority for them. What they have been focusing on is the two measures of inflation, the consumer price index, which is put out by my friends at the Bureau of Labor Statistics, and the personal consumption expenditures and the personal consumption expenditures index, which comes out of the Commerce Department. Those are viewed as inflation measures. And what the Fed will do is look at whether or not this stronger than predicted job growth is an indicator that maybe the economy is running a little bit too hot and we can expect a little bit more inflation than maybe we had expected. If that is the case, then they might moderate their decision making in November. They won't meet again until November, and either not cut rates at all or temper the rate cuts to 25 basis points rather than another 50 basis points. My guess is that they're probably going to continue their rate cut planning. They had turned directions and that they now think the economy needs a little bit more help with growth, even though the economy is growing at about a 3% rate. And so I think they'll continue to cut rates by 25 basis points in November.
Yeah. I'm looking at the CME Fed Watch to see what traders are thinking about all of this, and it's just up a slight hair. They're really selling that 25 basis point cut in November. And again, that meeting is coming the days following the election. So that's an interesting as they go in. Agree with you. I think that they're on the path, but this would show that the economy is very strong. As you mentioned, at a 3% rate. Now we've got 250,000 again, 254,000 jobs added in September. Right now, talk to me a little bit about this, Seth. Last month when we got the jobs report, we were revising downward the previous months. Now we're seeing a big revision upward. What's going on with these revisions? What's happening behind the scenes here?
Well, BLS gets additional data in. The initial number is an estimate based on early survey returns. They get additional information and more extensive data that come in from their surveys that they do with the Census Bureau, and that allows them to get a better estimate. They do one big annual revision based on changes to their benchmarking, but then they do revisions as they go. And what's intriguing about these revisions, at least the month-to-month revision, is they look big in the context of an effort to assess what's happening in a particular month. But if you put them in the context of the economy as a whole, remember, we have about 170 million working people in the United States. So a revision of 50 or 60 or 70 or even 80,000 jobs is a few tenths of a percent of that very, very, very large population of folks. So they're tweaking, but they're getting it better than 99% right in their estimation. Now, the problem is that policymakers are making decisions on these numbers,
Right.
and people on markets are making decisions, workers are making decisions, employers are making decisions, and so these revisions become very, very important. And that's why the folks at BLS and people like me who comment on their outputs should say every month, don't make a decision based on 1 month's data. Look at trends, look at larger phenomenon in the economy. Take all of these data together, not just over months, but together with other data that are giving us some indication about what's happening in the labor market.
As I continue to look more into the jobs report, and let me know if you're seeing other things in here that you want to specifically address. We talked a little bit about wages, and I'll mention again that they were up 0.4% on the month and up 4% over the last 12 months. So that's wages increasing 4% over that time. And in addition, labor force participation seems relatively little changed. Are you seeing anything in the sectors that you wanted to point out here?
That's what I'm looking at right now. So we have growth in food services and drinking places, healthcare, which grows no matter what's happening in the economy. It's the Energizer Bunny of job creation. Government grew and that's continuation of a trend. BLS tells us social assistance grew. Construction continues to grow. I'll have a comment on construction in a minute. And the other industries, including manufacturing, were flat. Professional business services were flat. That's where temporary help agencies are. That's an indication that things are pretty stable if they are flat. So much broader job growth this month than we saw last month, which, as I said in the introduction, is a very, very good sign. I do want to comment on construction, because we're now seeing fairly consistent 5-figure increases in construction employment month to month. That is very likely the effect of the huge public investments that were enacted by Congress at President Biden and Vice President Harris's urging. The bipartisan infrastructure law, the Inflation Reduction Act, the Chips and Sciences Act, they are funding all kinds of construction, particularly infrastructure construction, all across the United States. The investments in the Inflation Reduction Act are funding energy-related and renewable energy-related construction, and the Chips and Sciences Act, which is being followed by hundreds of billions of dollars in private investment, is driving manufacturing construction all across the United States. I think that those investments, as you would expect, have put a new and higher floor on employment in the United States.
Mm.
This construction growth and growth in related industries, even things like transportation and logistics and warehousing, which are growing because those sectors are where the goods that are needed to do the construction are kept and how they're moved. I think is
Mhm.
going to be a big story as we look back on 2023, 2024, and also 2025 and the employment picture in that space.
And construction is one of those really important sectors that we look at to point to the health and growth of the economy. And you're saying that a lot of this is attributed to public funding. I want to talk a little bit about the private sector as well, because as the Fed continues its rate cutting campaign, it's going to make borrowing cheaper. And do you anticipate that we will begin to see more investments in the private sector, more building, and a further injection into the construction sector and others?
Well, that's the idea behind the rate cuts, is to
Yeah.
try to get private sector to borrow more and spend more on plant and equipment, on technology, on research and development, and potentially on workers. I
Hmm.
I don't think that a 50 basis point cut is enough to meaningfully change employer behavior simply based on the cost of capital. I
Mm.
think it's much, much more likely that employers who are hugging their workers as tightly as they possibly can right now because they don't want to have to go out in the labor market and find new ones. It's just too hard. And that's why layoffs are at a low level, not terribly low, but at a low, moderate level right now. But those employers may be looking at the Fed cutting interest rates as a signal that they can relax a little bit and maybe begin to hire again. Because what has
Okay.
happened in the economy leading up to this big number that we got today is employers had not been hiring. Hiring had gone down meaningfully. The number of job openings had gone down meaningfully. So it's possible that the Fed saying, okay, we're now on a rate cutting path, are
Mm.
signaling to employers, you're going to be able to grow, the economy is going to be able to absorb more outputs from you, more of the goods and services that you provide. So you should go ahead and start hiring again. Now they're not going to go gangbusters. They're not going to just open up the doors and hire everybody who walks through. But you can
Hmm.
see them incrementally increasing their hiring to reflect the new focus at the Fed on growth.
Can I share that we're talking about this rate cutting cycle and how much the Fed may cut in the first week of November and 2 days following the election? And I mentioned that I was tracking CME Fed Watch. So they look at probabilities of how much the Fed will cut its interest rate by looking at interest rate traders and their activity. And right before these numbers came out, about 68% were saying that they expected the Fed to cut by 25 basis points in November. And I just refreshed my page and it's already up to 87%. So from 68% to 87%, I mean, they're really locking in a 25 basis point cut right here. There's no zero. So there's that. No one's betting that the Fed
Well,
isn't going to cut in November.
but there's an important input that you didn't take into account, and that is that you and I just predicted a 25 basis point
And they were
cut, and
listening
so
and said,
we're moving markets here on Straight Arrow News with our predictions about what the Fed is going to do. But I just think 25 basis points makes a lot of sense. With this jobs report, which is saying to the Fed there's some volatility in the labor market. I mean that
mhm,
is the big story here is we thought things weren't going so well. They were actually going moderately, not great. This is I would say, a very, very good number. So the Fed is going to be cautious. This is a very cautious group of people by nature. That's
yes.
almost who they hire, is people who are quite cautious, who are data driven, and they're going to look very closely at their beige book. But at the end of the day, they're also trying to set a tone for the economy, as I was just saying. And 25 basis points is a gentle nudge that we're moving towards growth. everybody loosen up a little bit, start spending, start hiring, start moving a little bit more, not too fast, but a little bit more.
Seth, you called this before the numbers even came out that September was just not a dramatic month. Nothing really happened in September that would have moved the labor market. We mentioned the Fed cut, but that wouldn't have affected the numbers. They'll be, seen later on. That said, October is not undramatic. We're going to have Helene, we'll have the Boeing strike, and even for a slight 3 days, there was the dock worker strike, which has now been, their contract has been extended to January. We'll talk about that in a little bit. But do any of these things, do you anticipate that they will be affecting the October numbers?
The hurricane is going to have a substantial effect on numbers coming out of the entire Southeast. We're going to see a very large number of people who are temporarily laid off, and it's hard to know exactly how long that's going to last, and because the terrible tragedy that's hit Western North Carolina, but also Florida and Georgia, and the swath of the hurricane was quite broad, and it hit a lot of population centers. So I think that is going to have a meaningful effect. We saw a meaningful effect from Hurricane Beryl that hit Texas earlier on. It's not a long-lasting effect, but it is a meaningful effect in the numbers. The Boeing strike is only 33,000 workers, so it matters for Washington State, but within the context of the larger economy, I mean, it'll show up in the numbers. Those folks will be identified as being temporarily out of work. The longshore strike happened outside of the survey period, and so it won't even show up in the numbers. It'll be interesting to see if the Boeing strike lasts through the survey period. The survey period will begin next week.
Okay.
So I'm sorry, not next week, the week after next. It's the week with the number 12 in it, the day number 12 in it. And so I think that if the Boeing strike lasts, that will show up, but it'll be a very, very limited effect. The hurricane will by far be the biggest effect. So what that tells us, and I think your point here is a very important one, the Fed is going to be looking at these numbers, the September numbers, much more closely than the October numbers, because the October numbers have exogenous factors affecting them that are not part of the underlying trends in the economy.
When people go on strike, when you have tens of thousands of people on strike, how long does that take for it to show up in the employment situation? Are they immediately there? Does it take a few weeks? What happens there?
It all depends on whether or not they're on strike during the period when the survey that's the basis for this report is done, which is the week with day number 12 in it every month. It's not necessarily the same days, but it's always the week with day number 12 in it. So that's why the longshore strike will not be counted, because it happened at the beginning of the month. And it's why the Boeing strike might be counted if it continues. It started after the last survey, but it might continue. And my guess would be that it will continue through the next survey. I don't see a lot of progress being made in that strike, in those negotiations, unfortunately. So it all depends on what's counted when. It's not a function of whether those workers get unemployment insurance. That would be counted in another survey, the initial weekly unemployment claims report that comes out every week from the Labor Department. So they would not show up there if they're in a state that doesn't provide them with unemployment insurance, but they would be counted here if they're out during the survey week.
What was your initial reaction to hearing that the dock workers extended the contract and extended talks through January and are getting back to work?
Well, it's good news. It's very good news. It's especially good news for those workers, but it's also good news for the economy as a whole. I was pleasantly surprised that the strike ended as quickly as it did. I had been predicting a somewhat longer strike, maybe a week and a half. But what happened was the employers relented much more quickly than I thought they would. This is a group, this is a bunch of very, very wealthy foreign corporations who are shipping companies as well as ports and terminals companies. So they're jointly owned, who made a mountain of money during the pandemic and really since.
Mm,
And my understanding is they're sitting on very large pots of cash. But I think they must have made the estimate or the assessment that it's not worth spending the cash because spending the money isn't going to produce a different outcome. And that was signaled when the ILA dropped its wage demand to around where this deal ended up. What the what the ILA was basically signaling was, and perhaps they said this directly to the company's trade association, the U.S. Maritime Alliance,
mhm,
the wage rate that was set on the West Coast in the deal between the International Longshore Workers Union and the Pacific Maritime Association, which is the West Coast ports and the West Coast longshore workers, that wage was going to be the floor below which the ILA would not be able to agree. They would not be willing to agree. And so this ultimate agreement takes the wages on the East Coast and the Gulf Coast to over the life of this 6-year deal to slightly above the West Coast number. And
mm.
so I guess the employers realized we're not going to be able to get them to a lower number. We might as well settle now and not spend all of this money on shutdown operations and ships anchored off of the coast.
Yeah, and there's a cost to them, but also a massive cost to the economy. Analysts were expecting that for every day it was shut down, it could cost up to $5 billion. I mean, this is just, it was a lot. We had 3 days down. It's going to take a while for them to catch up, even those 3 days, up to 2 weeks probably, for them to catch up on those operations. And to your point, the wages on the East Coast were like nearly half what they were getting over on the West Coast. So, uh, are you surprised they were able to kind of make up that ground in this? And do you anticipate that, although they've been given another few months to hammer out the details of this, that there's probably little risk of a strike down the road in the immediate
Well, with
term?
respect right, with respect to wages, this is what the union has been focused on from the very, very beginning. President Daggett and his leadership team have been talking about the potential of a strike since the very beginning of negotiations. They were
Mm,
signaling to the companies that we are ready to go out on strike. And they put a lot of effort into rallying their members and also rallying dock worker unions around the world to support them. And other unions in the United States, like the Teamsters, signaled that they were going to support this dock worker strike and not cross picket lines. So they were ready for a fight. They wanted a fight if they could not get the wage increase that they wanted. And I actually thought that the automation issue was going to be as important as the wages issue. It turned out the wages issue was really primary for the union. But they
mhm,
sent that signal hard, strong, consistently from the very, very beginning. And the members
mhm.
responded and were extremely supportive. And let me just say, if you don't have longshore workers, you do not have imports and exports out of the East Coast and the Gulf Coast. There is no replacement for those workers. I mean, maybe you can fly some things in or go to Canadian ports or West Coast ports, but that's much, much, much more expensive. Will they be able to
Yeah.
settle on the other issues? I think they will. I think the wages issue, we now know that the wages issue was the priority issue for the union. There's no question that automation is a tremendously important issue to the members and to the union because it's all about jobs. They don't want their jobs to be displaced by robotic tools, other forms of automation. There are AI forms that could be used in this context. And we have seen that the best way to resolve those kinds of issues is through collective bargaining. We saw it in the Hollywood strikes by the Actors and the Writers Guild and the theatrical and stage employees. We've seen it in the context of your industry, the information industry,
Mhm.
other industries as well. We're going to see it in the financial services sector in a big way very soon. So I think collective bargaining is a way to give workers a voice in those decisions by pushing the deadline to January 15th and not staying out on the automation issue. What the union is saying is we think we can get to a deal. They will have less power in January because cargo volumes go way down after the holidays. And
Mm.
so they will not be able to have the same kind of effect on the National Retail Federation and other manufacturers and others in the United States by waiting until January. They'll still be powerful. They'll still have a lot to say to their employers. But I think they're signaling that we think we can get that issue done.
Yeah, so then we're not even going to talk about them not getting the issue done. It really does sound like that is a promising step right there. I want to talk a little bit about, we were talking earlier about sectors and growth seen in them, and you mentioned healthcare, how that always grows no matter what. But I'm curious because there are a couple of different sectors like that we can call them catch-up sectors. So we've got healthcare, education, government, where they had lost a lot of jobs in the pandemic, or lost a lot of people, needed people to be coming into filling those jobs. We always need healthcare jobs, right? Do you think that these sectors are close to being done catching up? And will that affect what we're seeing in the future when it comes to our monthly jobs reports?
I want to take healthcare out of that group because
Okay.
it has been so chronically understaffed for
Mm,
such a long time that I think that they could grow at this rate or faster for the next several years and not get where they need to go. It's also important to note that demand for healthcare continues to grow, particularly as the population ages, demand for
right.
healthcare grows. So I would say that there is no smart person who would bet on job growth in the healthcare sector going to zero or falling anytime
Yeah.
soon,
Yeah.
maybe for years. Um, the government sector, there's still room for growth. They were about 800,000 jobs below where they needed to be. They have clawed back some of that, but not all of that. But there's plenty more room for growth in the government sector. And that's merely to get back to where they were, as opposed to where they need to be in providing the services that are needed. That's true in the education sector. It's true in other sectors of government, just general services, certainly policing, other places. There's plenty of room for growth there. Leisure and hospitality, the industry there made, at least the accommodations industry, made a big push to downsize their workforce. And so they have
Mm,
changed their service model by, for example, not providing cleanup services in hotel rooms every day that you stay in a
mm-hmm.
hotel. You have to request, sort of go to the front desk and beg for it. And so they've
Mm-hmm.
tried to scale down the number of people they have working for them. Again, all about maximizing profits. They can't argue that it's the pandemic anymore. The pandemic is largely over. Whether or not they ever get back to what had been their full employment level, I don't really expect. Again, that is a growing sector, and there's room for that sector to grow. Um, but as a general matter, we have such a dynamic economy, and we have so many industries that are growing. We have a 3% growth rate in the economy overall. There's still plenty of room for demand for workers in the American economy, and and that's one of the reasons why. And you made this point early on in the conversation. That's one of the reasons why immigration is such a critical part of economic growth for the United States. Bringing
Mm,
in not just skilled workers, but workers who are either undocumented or are coming in who don't have sort of middle class skills yet, but maybe are able to develop those. All of those workers are going to contribute to American economic growth, and we should be welcoming them into the United States. And our policies make that very difficult. We have a broken immigration system. We have a lot of xenophobia and racism in our society that's making it hard for immigrants. These are people who are doing very, very important work, ranging from home health care to some of the most sophisticated technology work in Silicon Valley. They're big, big, big economic contributors. And the only way we're going
mm-hmm.
to fill the jobs that we need to fill is to welcome immigrants into the United States.
Yeah, and this is obviously a very political topic, but if we take the politics out of it and we look just from an economic perspective, you have an aging population here in the United States. The fertility rate is continuing to drop. We will have fewer people to replace the people who are here. And to your point, there's only a couple of routes to go to be able to get people to work, and one is bringing people in to be able to fill those jobs, whether skilled jobs or, to your point, let's call them entry-level jobs or unskilled labor. And it's either that or automation, right? Like there are in the economic world, there are really just two routes that we're going to be able to go here to solve what is coming down the pike, which is an increasingly aging population. We're going to have more people out of the working age population than in it one day.
I think that's precisely correct. And those who are aging out of the population are going to be in desperate need at some point of care, right? So we have a care crisis in the United States. We have a child care crisis where we have a severe market failure where there's very, very high demand and there is insignificant supply. There's not enough, not insignificant, but insufficient supply is the right word there. And in circumstances like that, in markets that work, price goes up, right? So you lure more people into supplying childcare by raising their wages, dramatically raising their pay. That is not happening. And the reason is that many families simply cannot afford it. And so we need a third party payer, in this case, government, to be able to support childcare. And the same thing is happening in elder care with home health aides and others. We need a third party payer, the government. Maybe insurance would work, although we haven't seen a model that does work yet, in order to pay more to these folks who are providing these critical services that so many people need. Parents of young children and parents and the adult children of older parents all need the same help, as well as families with people who have disabilities. All of those folks need the additional support in their homes. And without that support, they have great difficulty participating in the labor market. They have to curtail their labor force participation. This is a particular issue for women who remain the principal care providers in our society. And so if we want more labor force participation, we have to address the market failures in the care economy. And the only way to do that is for government to get involved.
Okay, before I let you go, Seth, I just wanted to talk about one other thing in the jobs report. And if you had one more thing, let me know. I wanted to talk specifically about the biggest driver in this job gains right now, which was the food services and drinking places, which added 69,000 jobs in September. The Bureau of Labor Statistics is saying that's well above the average monthly gain of 14,000 over the prior 12 months. This is not a sector like healthcare where we constantly see jobs being added in this area. To this degree, what do you anticipate is happening there? What are your tea leaves telling you?
Yeah, it's hard to explain. I don't have a good guess. This is the September jobs report. You would expect food and beverage demand to go up in summer months, right, rather than to go up in the beginning of the school year. So it's I don't have a good insight there. I think you need to bring a food and leisure and hospitality expert on to tell you more about that. But I also find that very, very striking. That was the single sector that grew the most. Healthcare was second, and it looks to me like government was the third in the sector growth. I was looking at the race and sex breakdown of the unemployment rates. I did not see a lot of movement there. Men, the number went down from 4% last month to 3.7%. Teens ticked up a little bit. That number tends to be quite volatile because the numbers are quite small. White unemployment went down. Black unemployment also went down, and Hispanic unemployment also went down. Asian unemployment was flat. So I didn't see any very, very big moves there. The growth, the decline in unemployment for men and also for African Americans may well be the construction number, but it may be some of these other sectors as well. So not a big change in the comparative position of different groups in our labor force.
Okay, well, let me put on my food services and drinking places hat for a second. So my theory is going to be that school started and no one did their meal prep well enough. So they're just getting back into the routine and they're like, you know what, we're going out today. We don't have dinner prepared for you.
That's as good a theory as any. That's as good a theory as any.
Along with our economic indicator of SOC level, that's what we bring for you at Straight Arrow News today, just the real high level stuff. But really, this was such a fantastic conversation, Seth. To cap it all off. Obviously, you started at 8:30 this morning saying, wow, 254,000 jobs added in September, more than 100,000 over expectations, and unemployment went down to 4.1%, a fairly good number when you look at the longer history. So Seth Harris from the Burns Center of Social Change at Northeastern and our former Deputy Labor Secretary, we really appreciate your insight today. It's just been a great conversation.
Thanks a lot, Simone.